Never sell in a crisis.
Never sell in the That is so hard. That's the most difficult thing to do.
Market timing, no one successfully can market time.
You also emphasize on the fundamental weightings. So could you give a little bit?
This is really important. And I began to think of it because to me it doesn't seem that long ago, but it was 25 years ago. We had, and our research says we can. And so that's what gave us the thought. You don't have to follow just the companies that just keep on going up and up and up. The market has always come back and has always proved those people that are doomsayers that say, oh, it's all over with, wrong.
안녕하세요 여러분. 오늘 또 특별한 손님을 모셨습니다. 금융시장의 역사와 장기 투자 전략에 있어서 굉장히 오랫동안 시장에 많은 영향력을 끼치고 계시는 프로페서 제레미 시겔 씨를 모셨고요. 시겔 교수님은 주식의 장기 투자라 그리고 투자의 미래의 저자로 굉장히 오랜 기간 동안 이 주식 시장을 관찰해 오셨고 장기 투자와 배당 성장을 굉장히 중요하게 강조를 하셨습니다. 오늘날과 같이 변동성이 좀 높은 시점에서 교수님과 함께 시대를 꿰뚫는 통찰하는 전략은 무엇인지 그리고 어떻게 우리가 장기적으로 투자를 좀 바라볼 수 있을지에 대한 이야기를 오늘 나눠보도록 하겠습니다. So, Professor, thank you so much for having us here. So, could you maybe briefly introduce a little bit about yourself to our Korea audience?
Yes, I was always interested in economics and finance, and I started teaching at University of Chicago for 4 years, and then went to Wharton in 1976, and taught there ever since. So almost 50 years there at the Wharton School.
50 years. Yeah. It's like 5 or 6 decades you've observed the market, right?
Yeah, long time.
Wow. I mean, people, they tend to predict and tend to think based on their own experience. And mine is I told you before, I only have 15 years of history observing the market. And having you, looking over the market over the very long time, I think so that kind of thing would give us a lot of insights today. So I'm looking very forward to it. So maybe first of all, a very basic question. Since you've studied the market for a long time, looking back at the history, what period does today's market remind you most? Or do you think this is a whole new era?
Nothing is exactly the same, and this is a very unique period. The potential of tariffs, and that is something we have not seen even during my lifetime. Back in the 1930s, we had high tariffs, so this is a new experience. We're going to learn more about that. But one thing I always know, and that is that emotion in the short run often drives the market. Mm-hmm. But the basic values are the most important long-term determinant, and I still think those basic values, no matter what policies change in the short run, make stocks the best long-term investment.
So, you've witnessed a multiple crises, like stagflations in 70s, dot-com booms in 90s, also financial crisis as well. So having observed that all crises and all the, difficult times, what lessons have you learned that today, for young investors?
Never sell in a crisis.
Never sell in a That is so hard. That's the most difficult thing to do.
Market timing, no one successfully can market time because it's against the emotions of the time, and it becomes very, very difficult. And in fact, if you invest in bear markets more, your return will actually be larger than it would be if you were just in a buy and hold. So no matter what the crisis and the bad times that you see now, that is no reason really to sell at all for the long term.
we all know that by our head, but our heart just doesn't let that do that, right?
It's against the basic human emotion. That's what I learned by studying long term, how persistent the long term return is in the market. No other asset class shows the consistency long run that actually stocks do. They have a lot of short term volatility, but they have the best long-term stability.
So, I mean, you just emphasized the long-term investing. So if you had to highlight like one fundamental investment principles, like what would that be? Like, so if you're entering into stocks, what kind of stocks that we should actually look forward to?
Well, my research shows that certainly all stocks as a whole are good, but the better stocks in the long run are those that have more reasonable prices relative to fundamentals, and those fundamentals are dividends and earnings. Those companies that have lower price to earnings ratios and those companies that have higher dividend yields and growing dividend yields tend to have a better long-term performance. Certainly what we call the risk profile, which means that they often give you as much return and sometimes more, but less volatility than many of those other stocks that do not display those characteristics.
Yes, I mean, talking about dividend, like I did my research on your books and kind of articles as well, and you constantly kind of emphasize the investment principles of like that remain strong regardless of market condition is dividends. So,
Yes.
so like, can you a little bit like elaborate a little bit more on why we should actually care about like dividends?
Yeah.
Like,
Well, there's one chapter of one of my books, it's called Show Me the Money. Dividends proves that you got money. You're paying out cash, not just a promise. It's a hard number. Earnings are important, of course, the source of dividends. Different countries, different accounting techniques. You can play games with earnings. You can't play those games with dividends. And if that back in the 19th century, companies used to give all their earnings out as dividends as proof that they actually made money. Now, over time, that has changed. They used it to reinvest, buy back their shares, but it still remains an extremely important part of any strategy for accumulating long-term wealth.
I mean, but the one thing that kind of astonished me was that the stocks actually gives you better performance over the long run, are the stocks that is kind of considered to be a little bit of old-fashioned, right? Like people have ignored those names while the Max 7, so-called Max 7 have run the market. So what's your thought on these like tech stocks, and like how should individuals, just retail investors, how should we actually balance the portfolio within the growth and the value over the long run?
Investors get excited about what we call a narrative, a story. Back in 1997, 98, 99, they got all excited about the internet, brought them all up, and any other company, oh, that's not interesting. Well, that did not end very well. Now, the recent companies based more on AI and artificial intelligence have a much better basis and much stronger than those companies back then. But AI is still a narrative, and narratives don't last forever. We begin to see, I think, some cracks in the AI narrative. And what I mean by that is that we're finding out that you can do things with artificial intelligence that don't always have to use the most expensive chips. In China, other countries have been showing that they can do large language models, AGI, AI, at a fraction of the cost. So one wonders, AI is wonderful, but don't forget, many of these companies are, because they're exclusive and they can only do it. If others can come in, then that narrative changes. So you gotta worry about a change in narrative. And we might be seeing that now over the last couple of months. Oh, maybe those stocks should not be the only ones that I should hold, and the ones that are selling at much more reasonable price earnings ratios are the ones that are going to give you value into the future.
Yes. I mean, one of the things that I thought was that, just following the market sometimes let you miss it out. Sometimes makes you buy stocks over their value sometimes, right? So that's one of the problems with the market cap weighting itself. And whereas like I saw I saw so many articles and books, but you also emphasize on the fundamental weightings. Yes. So could you give a little?
Yeah, this is really important. And I began to think of it because to me it doesn't seem that long ago, but it was 25 years ago. We had for many younger investors, they hardly remember. But we had that big internet bubble. People were talking about Cisco and JGS Uniphase and AOL and other companies, Yahoo and others, as to be the only ones to hold. And they went up in value dramatically. And I was a big fan of capitalization-weighted indexing. And so I was holding these companies. I said, I don't want to hold all these companies. And that's when I began to think about maybe there's a better way to invest. Maybe instead of capitalization weighted, in other words, weighting every company just by its market value, we take a look and weight it by its fundamental value. Two most important, dividends and earnings. And so we did a lot of studies here at Wisdom Tree, actually to starting the company, to say, if we weight by fundamentals, dividends and earnings, instead of just capitalization, can we give you a better risk-return trade-off than capitalization weighted? And our research says we can. And so that's what gave us the thought. You don't have to follow just the companies that just keep on going up and up and up. And everyone tells you how much money they make, and you don't want to lose out. We call that FOMO, fear of missing out, right? I mean, so that's what actually brings habits in investing. Just, what are my friends making money? And you get in, it's near the top.
I know, it's always.
It's always the top, and you find yourself on the downside. And then by concentrate, it's not a gambling casino.
Sure.
I mean, stocks have a positive net return. In a gambling casino, you can make a lot of money in the short run if you're real lucky, but in the long run, you're going to lose. In the long run, you're going to win with stocks. And that's, it isn't going to be necessarily as exciting as everyone who tells you, I own this stock and it went all the way up. But at the end of the day, you'll be doing better.
Sure. So try to keep patience in the market time like this.
Absolutely.
And try to be on the steady.
Slow, steady track has always been the best. I do not sell during the panics. In fact, the panics, when they're actually lower, and you reinvest your dividends, you're actually, we call that dollar cost averaging, you are actually buying more shares. And even companies who buy back their shares can buy more shares. So actually, periods of low stocks that are, let's say, below true value, actually can help you get higher value later on. So it's nothing really to be scared of, because the value will come out at the end.
Well, it gives me a really relief, since this is the thing that you've learned over the past five or 6 decades.
Yes.
So thank you for having my mind set a little bit.
Appreciate that. It's taken many years of learning that, and if I can help others with their long-term perspective.
I didn't sell yet. I didn't sold my stocks yet. I'm just keep sitting, but I didn't put my additional money yet. But maybe,
If it's only, our market's down maybe 10% at this point. I mean, if it goes down much more, I have some cash, probably put a little bit, but I don't try to time the market. I could comment on the market, I give you opinion, but I'm a longer-term investor, so. It's just holding the diversified stocks, a big number of them based on fundamentals to give you the best long-term performance.
Yes, mean, my last question here was that if you could give one piece of advice to investors looking ahead to 2025 and beyond, based on your decades of market experience, what would it be? I think you've given me a lot of advice already. So, any last words to our
Yeah, the last
audience?
word, don't get scared out. No matter what the headlines are, don't get scared out of the market, because the market has always come back and has always proved those people that are doomsayers that say, oh, it's all over with, wrong. You know, it's especially important in the volatile times that we've had so far in 2025.
Okay. I mean, thank you, Professor. It has been a very insightful
Thank you.
conversations that we had.